In this session, we're going to consider the concept of tracking error. And the first thing to appreciate is that tracking error is going to be an alternative risk measure that we're going to use to assess the volatility of the returns produced by a portfolio. But unlike the standard deviation or the total risk as a measure of volatility for the total return series, what the tracking error is going to measure is actually the volatility of the difference in the returns produced by a managed portfolio compared to the returns produced by an underlying benchmark. So the idea behind tracking error is if you're a manager that's being benchmarked to, say, the S&P 500, then the total volatility of your returns isn't necessarily the point that an investor is going to care about. What they want to look at is what additional volatility that you might be producing with the returns your portfolio generates compared to the benchmark. For instance, if they've already decided to invest in equities, then they've accepted the fact that there's going to be risk of being an equity investor. So what they want to know beyond the volatility of your total returns is what is the relative volatility of your portfolio compared to the benchmark. So when we calculate tracking error, and it's going to be a fairly simple approach, but we have to make one important adjustment. We're not going to calculate the standard deviations of the returns themselves. But what we're going to do is for each period that we're looking at, say we have monthly returns, we're going to take the difference between the returns to the managed portfolio and the return to the benchmark or the index to which the manager's performance is being benchmarked. And so let's call that return differential in each period the delta. And then what tracking error represents is simply going to be the standard deviation of the differences in returns. And so that formula is shown there. We'll look at some examples in a second. This is going to be what we'll call the periodic tracking error, because it's going to be a number that will be relevant to the particular periods in which the returns are produced. So if you have monthly returns, it would be a monthly number. If you have quarterly returns, it would be a quarterly number, and so on. Almost always you'll see tracking error reported on an annualized basis. And so the way we get an annualized tracking error is to take the periodic tracking error multiplied by the square root of the number of return periods that you're working with. So again, if it's monthly, P would be 12. If it's quarterly, P would be 4, and so on. Now, to give a little context before we look at an example, the way most people use tracking error is to look at the risk relative to an underlying benchmark. And so this is useful in terms of categorizing what type of portfolio manager you're dealing with. An index fund or a passively managed portfolio should have a very low tracking error. In other words, if the goal of the managed portfolio is to mimic the performance of, say, a benchmark like the S&P 500, then the returns that index fund produces should be very close to the returns for the index itself. And so a passive or an indexed manager should have a tracking error less than 1. And frankly, it should be a lot less than 1, like less than maybe 50 basis points or even 10 basis points, as we'll see in an example. On the other hand, if we go to the other extreme, an active portfolio manager is going to want to have a tracking error greater than, say, 3%. And most of the time, an actively managed mutual fund, say, will have a tracking error in the range of 4 to 7%. So the idea here is if your job as an active manager is to beat the index, then by definition, the way you beat an index is to produce a portfolio that is different than the index. And within that difference lies additional volatility, which is what tracking error is going to pick up. And then we have a middle ground between an indexed fund and an actively managed fund, which is sometimes called a structured portfolio. In past days, I would hear this called an enhanced index fund. I don't hear that language as much anymore. So structured portfolios is really more the preference. And that would just be a modestly higher tracking error than a passive index to allow for a little bit of active management in the attempt to produce an alpha. So let's take a look at a couple of examples. And again, the calculation is fairly simple because ultimately it's just going to be a standard deviation calculation. But this is an example from the book. And so we have a manager that has produced the following returns over the last 8 quarters. So 2 years worth of quarterly returns. And here is the index that she is being compared to. So the first thing we want to do is to just difference the returns in each period of the manager versus the index that she's being judged against. So for instance, she fell 40 basis points short in the first quarter. She produced 2.3%, but the index produced 2.7, and so on throughout the whole thing. So it's this return difference column that we're actually going to focus on. And so what tracking error represents is essentially the standard deviation of that return difference column, that final column that you're looking at on the page here. And so, by the way, if we look at the average of those return differentials, which, as you can see here, is shown to be 20 basis points, that's a measure of the alpha that the manager produced on a quarterly basis when we're using the index to represent the expected returns. So she beat on average the benchmark 20 basis points per quarter over the 8 quarters or the 2 years that we're looking at. So then what the quarterly tracking error represents is just the standard deviation of that return differential of the manager compared to her index, which you can see without going through the calculations shown there. And it turns out to be 1%, but remember that's a quarterly number. And so to annualize that, we would simply take that quarterly tracking error and multiply it by the number of return periods in a year, which is quarterly data, there'd be 4. So the square root of 4. So her annualized tracking error would be 2%. So she would be considered to be a structured portfolio manager, not quite an index and not sort of a fully active manager either. So let's take a look at some realistic data now. So far, we've looked at 3 different kinds of managed mutual funds. We looked at the Vanguard Index 500, which is an index mutual fund run by the Vanguard Corporation, the asset management firm. We've also looked at an exchange traded fund, which was the SPDR, if you remember, the S&P 500 ETF. And then we also have spoken of a actively managed portfolio by a money manager out of Houston named Fayez Seraphim. It's actually marketed by Boney Mellon, and it's their appreciation fund. And this is an actively managed fund. And so the thing to recognize is what I've shown you here is the last 10 years worth of annual data. And if you can see it in the illustration, the white bars represent the return in that given year. to the managed portfolio, the index fund in this case, the Vanguard fund. And the gold bars is the S&P 500 index. And so you can see right away that for the index fund manager, in this case, the Vanguard fund, you can see that the return are in every period very close to the returns to the index, which is what you would hope for if you actually have a managed index fund. And the same is true for the alternative way of providing an index fund, which is the exchange traded fund, which is the SPDR or the S&P ETF. Very close in each period. So we would expect to have very low tracking errors in that case. Now, the actively managed fund, again, is trying to beat the S&P 500. So you would expect that their returns would differ from one period to the next. Hopefully, it would be higher, as they are in some periods, particularly recently, for the Boney Mellon Appreciation Fund managed by Fayez Serafim. And so that return differential that's evidenced by the different height bars on an annual basis in the returns is where tracking error is going to reside. So what I've done is gather the data in numerical form for each year for the last 10 years, going back as of the end of 2021. And so here's our benchmark in the final column. That's the S&P 500. And then here are the three different managed funds, the two different indexed products, the index mutual fund and the exchange traded fund. And then the active portfolio is the DGAGX, which is the ticker symbol for the Boney Mellon Appreciation Fund. So then the idea of the calculation, again, we can talk through quickly. It's going to end up being just a standard deviation calculation. And so what we have is, if we just take a look at one of them, let's take a look at the Vanguard Index Mutual Fund. What we do in this column is calculate the return differentials each year for the 10-year period. So that minus 17 basis points would simply be the difference between the 28.54% return that this index fund generated for its investors in the year 2021, minus the 2871, which is what the return to the hypothetical return to the S&P 500 index would have produced. So this manager fell short by 17 basis points of perfectly mimicking the returns to the index in that period. And you can see that if we take an average of that over the 10-year period, they fell short on average by about 16 basis points, which is what you would expect in a managed product. You would expect it to fall short of the hypothetical index because there are going to be transactions costs involved in running an actual portfolio versus a hypothetical benchmark or index like the S&P 500. So you would almost always expect an index fund to fall a little bit short. Now, the periodic tracking error then would just be the standard deviation of that return differential column, which you can see is only 2 basis points. It's virtually zero, meaning that there was relatively no incremental risk associated with running this product. And so just to be clear, if you're managing an index fund, success would be to have a tracking error as close to zero as possible. In other words, you're mimicking the variation in the returns almost exactly. And these are already annual returns, so the annualization factor is just simply 1. So that would be the tracking error for the standard deviation of that return differential column, since they're already annual returns, is the annualized tracking error. Notice that, and by the way, those calculations are demonstrated here on the next page. Notice that for the two indexed products, the tracking errors are very low, virtually zero. And again, that's what you would hope for if you're hiring someone to manage a portfolio for you, that the whole purpose of which is to mimic the returns and the pattern, the volatility of returns in the underlying benchmark. You want it to be as close to zero as possible. And you can see these are virtually zero. They're in the range of 2 basis points to 11 basis points for the ETF. By the way, usually indexed mutual funds have slightly lower tracking errors than what would be the equivalent of exchange traded funds, because you actually have a manager on a day-to-day basis taking care of the portfolio that's actually invested to match the index as closely as possible. So there's a little more slippage for an ETF, but you can see not very much. Now, on the other hand, the tracking error for the actively managed fund is quite a bit higher. And you can see that with the pattern of return differentials from one year to the next is quite high. And frankly, on average, over this particular 10-year period, not very complimentary of the manager. They fell about 200 basis points short on average each year, with substantially more volatility than the index fund, but well within the range of what we would expect for an actively managed portfolio. And so this manager, again, their return performance hasn't been good, but what tracking error is measuring is the incremental volatility that's being added in the effort to try to beat the index. So if your job is to match the index, you would expect that incremental volatility to be virtually zero, which we see it is in the case of both of these indexed products. But if your job as an active manager is to beat the benchmark, you would expect to see more incremental volatility, which is what tracking error is measuring. And then finally, let me just note that Bloomberg produces these calculations as well. So what I've done is for each of these three index funds, looked at their annual data over the last 10 years, just the calculations we've looked at relative to the S&P 500. And you can see that 2 basis points for the Vanguard as a tracking error is reported, with rounding the 11 basis points for the S&P 500 Spider, or the ETF. And then for the actively managed Boney Mellon Appreciation Fund, the 5.31% tracking error is indicated as well.